Hello, everyone. Welcome to another episode of the Weekly Tanker Market Podcast. I'm Trisha, your host, and I've got to say I'm pumped about today's episode. It's the third week of 2025, and there's a lot happening in the tanker market. We've got Sandesh with us, our go-to expert on crude, CPP, and LPG markets, and he's here to break it all down for us. So, welcome back, Sandesh. It's always great to have you here.
Hi, Tisha. Thank you so much for having me here today. I am super excited to be here and chat about what's been going on in the market this week. So let's get into it.
All right, Sandesh, let's talk about the VLCC segment in the MEG first. It seems like the market has been on fire lately with owners pushing back on lower rates and sanctions cutting into available tonnage. It feels like there's a lot of action taking place. So here's my question. Is this rally that we are seeing just a short-term surge, or could we be looking at a solid trend carrying through the first quarter?
First of all, great question, Trisha. And yeah, the VLCC market has been buzzing lately. So honestly, this feels more like a start of solid trend rather than just a quick spike. And here is why. The tightening tonnage list is a huge factor, and owners, they are kind of definitely flexing about it. So with fewer ships available, they have got more leverage to push for higher rates. And you know what? It's really paying off. So for instance, TD2 and TD3C, they saw impressive gains, surging by 56% and 57% weakening respectively, and both of them closing at world scale 78 and similarly world scale 77.15. So adding to that, the sanctions on tankers carrying Russian and Iranian crude, they have really thrown a wrench into a global supply. It's like taking pieces of the chessboard and there are simply fewer options for charterers, and that shortage is giving up freight rates. So when you combine that with the sheer volume of outstanding cargoes coming out of the Middle East, Gulf and Atlantic region, it's created a kind of a perfect storm for owners to capitalize on the situation. Now about those February loading dates, they are definitely a game changer. So what's happening is a lot of charterers, they are already in a scramble mode and they are trying to lock in tonnage for late January and early February. So as those cargoes continue to come online, the tonnage list gets even tighter, and it's like the domino effect, and that keeps feeding into the higher rate. So you know what? It's a classic case of supply and demand working in favor of the owners, and they are seizing the moment. So yeah, I would say the momentum we are seeing now has some serious staying power, and it could absolutely carry into the first quarter. So unless there is a major curveball like sudden flood of new builds hitting the water or an kind of an unexpected drop in demand, I think we are set up for a very strong start to the year for VLCC owners. So this kind of bullish sentiment is driven by structural factors like tight supply and geopolitical pressure, and it doesn't just fade overnight.
That was definitely an insightful take on the VLCC market. Now, let's keep the momentum going and also talk about the WAF and the USG regions. So, if I'm not wrong, with tighter tonnage and the traders shifting their strategies, both regions seem to be on fire. So, could you share your thoughts on what's driving these surges? And do you think this momentum can hold up, or are we looking at a short-term spike here?
Yeah, Trisha, we can say that the WAF and USG regions, that means West Africa and US Gulf Coast regions, they have been buzzing lately and for a good reason. So let's start with WAF. Owners, there have been a kind of riding a wave of bullish sentiment, and the market hit a 7-month high last week. So the tonnage list, it is getting tighter, and activity in the MEG and USG market, it is adding fuel to the fire. So plus with the new US sanctions on the shadow fleet vessels, owners have been able to push rates higher by leveraging all the uncertainty. So for instance, if I have to say the TD15, it saw a fantastic increase of around 49.14%, and it got settled at around 77.39 world scale. And you know what? This is a great sign of upward momentum in the market, isn't it? So over in the USG, it's been just as exciting with respect to, if we compare the similar way with respect to WAF. In the rates for routes like USG to China, they have been absolutely skyrocketed, and they also increased by around 55.26%. And they jumped from 6.5 million to nearly 10 million week on week. Huge moves. So we saw one of the fixture last night, and it went even beyond 10 million. So you know what? The expanded sanctions, they are a big driver here too with, Indian and Chinese traders. They are now looking to Western tonnage and which has even tighter the supply further. So what's really interesting is how owners are adopting strategies like, ballasting from UKC to WAF or Brazil to match earning from USG to Far East routes, that is a long haul route. And it's smart play that's keeping that rally alive. As for whether this momentum can hold, well, we can't give a certain answer to that. But if demand from China and India keeps up and we see more inquiries pop up, this trend could definitely stick around. But if things slow down or we get a sudden tonnage influx, we might see some adjustment. So for now, though it's an exciting time for both regions, owners are in a strong position and you know what, they are making the most of it.
Well, it's definitely amazing to see how both WAF and USG are performing right now, with owners really capitalizing on these higher rates. So, thanks for that insightful update on the VLCC market, Sandesh. Now, let's switch it up a bit since we've talked about the VLCC market. Could you tell us how are the Suezmax and the Aframax segments doing? Are they following the same trend or is there something different going on there?
Absolutely, Trisha. The Suezmax and Aframax markets, they are kind of definitely having their moments as well, similar with respect to VLCC. Now let's start with the Suezmax. It's, really been all about increased activity out of WAF and the Mediterranean regions. So there has been this growing demand for compliant tonnage, especially with the US sanctions on shadow fleet vessels that's tightening up the market. So you know what I'm continuously saying in every section the US sanction on shadow fleet because it is the first time different vessels, even in the crude tankers and product tankers, those are getting sanctioned, and around 181 such vessels get sanctioned. So we have to mention it everywhere. That's what I think. So this US sanction on shadow fleet vessels, they are kind of a tightening up the market. So this is making Suezmax a top choice for many traders looking for vessels that can still meet the demand without running into sanctions issue. Now another factor is the VLCC market, where we are seeing some cargo split into Suezmax size parcels, specifically as some VLCCs get too large for the specific routes or ports. So this has driven rates up and we are seeing some solid gains in the Suezmax sector thanks to that added demand and shifting trade flows, for instance. So if I have to give the benchmark route, we have a TD6. It rose by around impressive 17.62%, and then we have a T20 also increased by 14.36% week on week. And both of them settled around 90.10 and 77.39 respectively world scale basis. Now, as for the Aframaxes, they are cruising right along, like you said. The Mediterranean and the Baltic markets, they are on fire, and you know what? A lot of that has to be do with the winter demand picking up, and it combined with the shortage of ice class vessels. So when you add regional disruptions like the strikes in French ports, Aframaxes are really stepping in to provide the flexibility that charters need. So they are in a high demand right now, and with the fewer vessels available, owners have more leverage to push rates even higher. So for instance, you know what, TD8 they increased by 7.2% week on week to conclude at world scale 138.21, and even at TD14 they also increased by 2.13% week on week to settle at world scale 111.38. So you know what, is both of these routes they are increased marginally, but the crux of the analysis is that they both are growing with respect to a similar kind, like a similar with respect to VLCC and Suezmax. Now both Suezmax and Aframax markets, they are definitely showing a solid gains, but right now Aframaxes seem to have the edge. The tight tonnage, across, or the tight supply across multiple regions, combined with the flexibility they offer, it keeps them in a really strong position. So yeah, overall I would say that it's been a great start to the year across the board, and owners are definitely in the driver's seat in these segments, and this makes the most of the tightening market and strong demand.
Thanks, Sandesh. That's a really great breakdown. It's really interesting to see how Suezmaxes are benefiting from the split VLCC cargoes. And on the other hand, the Aframaxes are also holding strong in the Mediterranean and the Baltic. So it's almost like every segment is finding its moment in the spotlight. So let's keep going. Sandesh, what's coming up next on our radar?
All right, Trisha. Next up on the radar is the CPP market, and there is definitely lot happening there. The LR tanker market saw some solid growth last week, specifically with the LR1 tankers. Those are going to AG Japan. We call it as a TC 555K route. It rose by 15 points, and LR2 rates on the TC 175K route, they are also climbing by nearly 39 points. TC earnings, they followed the suit with LR1s. They are gaining around $3,200 per day, and LR2s are adding over $12,000 per day. Now, in the MR segment, it also showed the strength, particularly on the TC12 and 35K route from Sikka to Japan, where rates climbed by 20 points. And you know what? They push earnings by 17.5%. Again, the sanctions on Russian-linked tankers, they have really tightened the global tonnage, and that's been a key driver of the rates hikes. So, East of Suez market, specifically for LR2s, they have seen a big gains, and as Asia scrambled to replace Russian naphtha, we may see these gains even higher in the coming weeks. However, West of Suez market have been kind of a quieter, and the MR segment has had a mixed result, strong in Asia, but softer in places like Sikka to East Africa. So in conclusion, I would say that the CPP market is seeing strong growth in LR and MR segments, and this is driven by sanctions and shifts in regional demand. The market is tight, but we say that opportunities for growth persist, and as demand dynamics, they are continue to evolve in coming weeks.
So, Sandesh, with all these new product tankers set to hit in the market in 2025, how do you see the market balancing all this extra capacity with the potential slowdown in the oil demand growth? In the sense, do you think there's hope for product tanker operators, or are we looking at a bumpy ride ahead?
Again, great question, Trisha. It's definitely going to be a bit of, I will say that tightrope walk, no doubt about it. We have got a huge surge in new tankers coming, and that could pressure on freight rates, specifically with the potential slowdown in oil demand and growth in oil demand. But here is the thing, product demand isn't just about the overall consumption of oil. So if you look at specific products like diesel and jet fuel, there is still a lot of movement there. The sanctions on Russia and then the geopolitical shifts are creating volatility. So with uncertainty, demand for tankers tends to rise in certain regions or for certain products. Also, the industry is focusing more on decarbonization. So that's pushing for newer, cleaner ships. There is an opportunity for operators who are quick to adopt more efficient vessels. So in fact, that could be the key difference between operators who struggle and those who survive and those who thrive. The surge in fleet size will add some pressure, but ton-mile demand is still strong in some areas, specifically with sanctions pushing longer haul routes. It won't be easy, but I wouldn't write off potential growth. We are facing a market with new ships and softer demand growth. But those who can be flexible and adapt to changing trends, whether by focusing on niche product categories, optimizing fuel efficiency, or navigating sanctions, they are still in a strong position. So in the end, it's all about staying nimble, thinking ahead and adapting. So while it's going to be a roller coaster ride, there is a definitely hope.
That's a fantastic rundown of the CPP market, Sandesh. Talking about the CPP market, the growth we are seeing in the LR segment is actually very impressive, especially with those massive jumps that you mentioned in the TC earnings. And it's crazy how the sanctions have also, really shaken things up. So thanks for breaking all of that down. Now, shifting gears a bit, we haven't really talked about the LPG market yet. So, what's been happening there lately? Are we seeing any significant changes or trends?
So yes, the LPG market is definitely buzzing, specifically on the east of Suez side. The activities they have picked up, and 7 deals concluded from both AG and Australia for the end January and end early February laycans. Rates they are hovering in the low 60s and high 50s per metric ton basis Ras Tanura to Chiba, with end January positions now getting a slight premium due to tighter tonnage. One of the key driver is the limited prompt tonnage, and owners they are really in the driver's seat right now. So despite the January fixing being concluded, a number of extra end January cargoes they have come in and pushing rates even higher. And you know what? That's been fueling the market a bit. Now looking at the West, things are a bit quieter. Rates have trended downwards and owners are eyeing the low to mid hundreds per metric ton for Houston to Chiba. So the big worry now is the cancellation of butane heavy cargoes, which is starting to weigh on the market bit. As we move into the February, it's going to be interesting to see how owners adjust their strategies. You know what? Some relays they are expected, and that could add another layer of pressure. So overall, I would say it's a mixed bag, but East of Suez side is holding strong for now.
Thank you so much, Sandesh. It's definitely fascinating, just like you mentioned, how that tight tonnage is really pushing the market on the east side. And on the other hand, it sounds like it's a bit of a waiting game in the west, if we were to say. But it's going to be really interesting to see how all of these trends play out as we move deeper into the year. And I guess with that, we will wrap up today's episode. A huge thank you to you, Sandesh, for sharing all of your expertise with us. It's always a pleasure.
Thank you, Trisha. Thanks for inviting me once again. It's pleasure to be talking to you and sharing my views to our audience. Thank you.
And of course, a big thank you to all our listeners for tuning in. Do not forget to share and follow us to stay up to date with all the latest market insights. Until next time, navigate safely and stay informed.